Hi, this is Craig with Red Chip Companies. Thank you for joining today's event with Alliance Entertainment, which trades on the Nasdaq under the ticker AENT. With us today, we have Bruce Ogilvie, Executive Chairman of Alliance Entertainment. Joining later will be Jeff Walker, the CEO. We will begin with a brief presentation in a moment, and then we will answer your questions. Users may submit a question at any time by using the Q&A tool at the bottom of the Zoom window. Before we begin, please allow me to read the Safe Harbor Statement. This call may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical facts should also be considered forward-looking statements. Of course, forward-looking statements involve risks and uncertainties. I now turn the webinar over to the Alliance Entertainment team. Please go ahead.
Greg, thank you very much, and thank you everybody for taking the time today to join us on our call today. This is just a follow-up call from our last earnings call, and I'm going to talk for about 20 or so minutes, and then I'll pause, and then I'll be happy to answer any questions at that time. I'm sure you can all see my screen. This is just a snapshot of our warehouse in Shepherdsville, Kentucky. It's roughly 800,000 square feet of square footage and mezzanine and automation equipment. On the left-hand side of the screen there, you can see our auto store system there. We'll talk about that more later, where it creates a lot of efficiencies for our operation, but I'm going to skip ahead here and just kind of describe. For those of you who are kind of new to us, Jeff Walker, and I see Jeff is on the call also here now. I joined Jeff in 2001. Jeff started the company in 1991. When I joined the company with Jeff in 2001, we're about $18 million a year in revenue. And then Jeff and I were able to grow in 20 years up to $1.4 billion there. What we are is we're a distributor. We're a distributor of entertainment products. These are your top-notch entertainment brands on the left-hand side of the screen here. These are not easy suppliers to get open with. You have to add value to the marketplace. You have to be a good distributor, a stocking distributor. You have to have fiscal responsibility, pay your bills on time, and be credible and add value. By being a stocking distributor of all these, which consist of movies, music, video games, and collectibles, we have over 325,000 SKUs that we stock. So we're a stocking distributor. We're kind of known as a one-stop or a long-tail provider to the industry of entertainment products. All these products that we stock in our distribution center, we dish them up and we put them in electronic data feeds, and we feed it to all these retailers on the right. These omni retailers, brick and mortar retailers, or pure online retailers, or your very small independent record store, over 2,500 across the U.S. there. Selling vinyl and entertainment products in their stores there. Now you look here, you see like Walmart, Target, Costco, Best Buy. These retailers kind of rely on us to be their long tail provider to expand their selection. We're able to come in and have all this metadata and the artwork and the images and feed it to them electronically. And it's very easy for them to keep their website up to date, keep the buy box lit up, and not have to worry about any expertise or sophistication or inventory concerns, just by leveraging off all the inventory we have in our Kentucky operation, and then we can drop ship it directly on their behalf, directly to their consumer. It's white labeled to look like it came from that retailer, but you won't know, but behind the scenes, it really came from our operation, which is over 40% of our total revenue, which is called drop shipping directly to consumers. The other 60% of our business is traditional wholesale, where we're shipping into brick and mortar retailers' location. They were price stickering it, they're adding value, putting security tags, whatever that retailer needs. So it's very easy for them to receive that product into their store, make the sale to the consumer, and just be that supplier, that back room that adds a tremendous value to those retailers there that want to buy from us. Oops. So as I mentioned, we bring entertainment to you. We're in a category that's about $10 billion in physical media. We're 1.1 billion of that 10 billion category there for 2024. Part of 250 to 300 million of our sales comes from exclusive products that we license and we distribute, or with the exclusive distributor. I mentioned the 325,000 SKUs we have in stock. I may have missed that we have 200 online retailers that we support with that, all that electronic information. We ship to 35,000 storefronts in 72 countries. We have a really good track record of growth by doing acquisitions. That's how Jeff and I got from that 18 million to 1.4 billion over 20 years, is doing over a dozen acquisitions there. That allowed us to enter new markets, expand our selection, gain more market share. And with all those acquisitions, we've been able to build a really, really strong team, experienced leadership with proven track record. And that just makes our bench very, very deep. And so, we can really expand our growth, and we have our sights on doing more acquisitions we'll talk about later. Right-hand side of the page, this was back on February 12th. Our stock currently is on sale. It's pretty good value today to buy, based upon the 52 Granger you can see there. I can't really say why our stock has, not been perceived very well. No bad news that we really put out there and all that there. The only thing I can think there is if you look at pure quarter over quarter, same year, and our earnings per share top line, it looks like we went backwards. But you may not be the investors may not be taking into account that we had a 5-cent non-cash deduct out of our earnings per share because of the warrants that we have, and because the stock went up so high in value around by 12/31, that created a $2.5 million non-cash loss. I think some of the shareholders might, not know this, or not taking that into account, but that's the only thing I can think that could explain all that there. Outstanding shares is 51 million shares. Important thing to note here is Jeff and I are fully vested in driving this company, making this company become more profitable, and really improve our earnings per share. Jeff and I own over like 94% of the stock in the company there, not to mention the employee owners who also were employee owned there. And we think those are all really good things that we're aligned. Jeff and I's pay package is, we like to call it the Elon Musk pay package there. If we can get that stock up to $20 a share within one of the tranches there, that's a huge milestone for the company, go from where it is to $20 a share. And then from there, Jeff and I would receive some additional stock as reward for that. So we're highly motivated to drive and make the company more value. And I think it's a win for everybody on this call today has an interest in the company. I talked about that 10 billion market there, just in different categories. By the way, I probably failed to mention this deck is available on our investment relations site. It's on the very first homepage there. You can always go to our ticker symbol, www.aent.com, click on the investors page, and you'll find this deck there. You can see it there. I want to talk about our 300 million trailing 12 months exclusive revenue there. It's over 3 different divisions there. Distribution Solutions and AMP. Distribution Solutions is our independent movie studio. We have over 60 movie studios we're the exclusive distributor of. And then the AMP division, we have over 90 music labels. We're the exclusive distributor of that. Those 2 labels combined alone, get us over the right around the $250 million range there. We have our Arcade 1UP division there also, which is arcades. And that's how we get over that $300 million trailing 12 months as of 12/31. The big growth area for us here we'll talk about is Mill Creek. Mill Creek just is our licensing division, where we license studio content from the home entertainment divisions there. The big news of the day for us there is we just recently entered into an agreement with Paramount Pictures, where we're going to basically put out all the Paramount Pictures movies from their home entertainment division going forward over a 3-year period here. It's not that Paramount's getting out of the movie business. Paramount, and not alone Disney and other studios, are all looking for ways. They want to focus on making movies and work on premium downloads. Their home entertainment division is the division where we actually manufacture the home video. They sell it to retailers like Walmart, Target, Best Buy, Amazon. And then they have to collect the money, deal with the returns, and chase down chargebacks. They just feel like that's not their core competency anymore, where making movies, and whether it be their streaming platforms, are where they want to focus on there. And that's where we step in. We can add value. We can license that. it's going to have a tremendous effect on Alliance's gross profit, this opportunity with Paramount. And we expect to do other studios after Paramount there. It's somewhere in the neighborhood of about $75 million in revenue for total calendar year 25. And from an EBITDA perspective, it's in the neighborhood of, $7 to $10 million range of additional EBITDA that'll add in there. So big win for us, higher gross margin. That's going to make a lot of our potential investors and current investors happy that they start seeing our gross profit improve. That's one weakness or one thing we've been challenged about, that we're right around the 12% range. And this will add some strength there to strengthen that area there. So big opportunity there. We're excited about that. I did talk about our acquisitions. Jeff and I did this over a 20-year period there. We're only going to start at 2013 and take us up to 2020 there. But the latest one that we just did also, and that was in the middle of December, we announced Handmade by Robots. That's a very exciting division for us there, and a great opportunity there. We are a Funko distributor. You probably saw that in my previous page of the brands we distribute. We've been a Funko distributor for many, many years, and that's our collectibles division there. We have that there. Well, the one thing that we noticed about Funko that makes them so successful is that they're always putting out new releases of new opportunities, licensed content, whether it be related to movies or music or video games, or some type of streaming event on Netflix there. And they would, and it's also Japanese animation. There's just a lot of opportunities there. Well, the one thing we didn't have that we thought if we could get was a form factor. A form factor is just a little molded piece, very similar to what the one that's made that Funko currently distributes there. And we picked up our own form factor from a very successful company called BDA, and they had this division called Handmade by Robots. Fantastic form factor, great character. It's really perceived in the marketplace. You can search online. You read nothing but positive things about Handmade by Robots. You'll find people calling Handmade by Robots could it be the Funko killer. Well, it's not going to be the Funko killer, but it's definitely going to add piggyback along on the success of Funko and the great job they're doing. Funko does about $1 billion in revenue a year. We're hoping within a couple of years, we'll be up within the $100 million range there. And taking advantage of our expanded relationships with all these IP providers of content, whether it be movies, music, video games, and collectibles area there, and look for the right licenses that we can make available. We're not going to stuff the marketplace. We're going to be limited. When we put in the marketplace there, we want to create scarcity so that it's not the channel is not oversupplied. Just make the right amount of quantity so that everybody is happy, and it's from the collectible standpoint there. We're very excited about that, and I think you're going to see good things to come with that with us there. Briefly, I'm just going to talk about AutoStore. This is the system we put in. We're currently starting our third year of AutoStore, and big picture, it basically made us more efficient. It lowers our fulfillment cost. If you look year over year, we're running about 1% lower in our fulfillment cost, and that's all driven by AutoStore. And basically, what we do with AutoStore, it eliminates the travel time, people walking to the shelf to get the product. Instead of them walking to the shelf, the robots bring the product to the processor or the picker. We went from 41 processor pickers before AutoStore, and now we're down to 7. Those same efficiencies we're getting with a put away when receiving product, we're also getting with AutoStore. When the product would come in, the person would have to find an empty shelf location, put it in. Now they receive the product, and an empty shelf comes to them. They easily store the product. This is being used for all our vinyl that we have in our Kentucky facility there. That's like a 300 million division of our business there. This is a scalable thing. We could certainly spend more money in CapEx in the future. We could expand upon it. We could get those same efficiencies for the rest of our business there. Nothing planned at the moment there. We're trying to be very protective of how we spend our CapEx, but we're really happy with the results. On top of the efficiency of getting more productivity of people not having to travel to the shelf, it created more storage capacity because you eliminate aisles with this system there. There is no aisles. You take advantage of the queue. So because of AutoStore and the extra capacity we got, we were able to eliminate about 162,000 square feet last year, May 31st. We moved that operation into Kentucky, and all because of AutoStore. So a big win for us, and that's just the thing. By the way, if you do go to the deck, you could click on a lot of great links here to see the pictures of our operation and what it's all about there. We'll just talk about the quarter that just ended there. I think that you can just see, our top line sales were down just a small tad. It was really primarily driven by gaming, and I'll talk about in our sales breakdown by configuration, where the weakness was. Movies was up, vinyl was up, CDs were about the same, so we were happy with all that there. So that's just really where we were at there. As I mentioned earlier, from a GAAP perspective, our earnings per share was down year over year there, which I can talk on the next slide there. So even though it shows our trailing 12-month there is 19 cents, for our earnings per share there in the middle here there, but there's a little footnote down there. The actual number was 14. So what the market is seeing, they're saying, okay, you were 14 and you were 17, so you're down. But nobody's taking into account that we had that 5% reduction there, which is understandable from a pure GAAP basis there. While we're on this slide here, you can see that our debt has come way down. We're at a high of 100 in fiscal year 23, right around 133 million. Inventory was 146. And then at one point, our inventory was much higher than 146 million. But you can see overall that you can look here at 249 million was the peak there. But we're now way down in the. You can see the numbers where we're at. You compare quarter over quarter, having this. What we're basically doing is we're just trying to turn our inventory faster. When money cost a lot less, when it was back in the days when it was LIBOR plus 2.25 range there, we didn't mind having a 90 to 120 day supply of inventory. Now with the discipline, we really want to have no more than a 60-day supply of inventory. So that's we're being that responsible in that area there. So what are we going to do? How are we going to get better? We're going to continue to grow our market share. We're going to look for opportunities there. I did fail to mention there that we are looking at a couple of acquisitions. One is a public one, which I can talk about there. It's a company that filed bankruptcy. It's called Diamond Comics. They just recently announced they were in bankruptcy. We were talking with the investment bankers before they filed for bankruptcy there. We are not a stalking horse, but there is going to be an auction coming up, and we plan to be at that auction there. That's about a $300 million a year business. They have two divisions there. One makes money, one loses money. But we think there's a possibility of some consolidation opportunities there. The jury's still out on it, but as I said, we plan to be at the auction there. A couple other companies we've been talking to, they're basically companies that the ownership is very old and they need to have a liquidity event, and we're a perfect vehicle for that. We generally don't try to rush those things. We just work through them very carefully there. But those are good opportunities, and that was like when most of the companies we acquired in the past, I would say the majority have been the same situation there where the owners want to have some type of liquidity. That's where we kind of step in there and try and make it a thing. We don't like to overpay. We try to come up with the right formula that's not going to hurt our shareholders and not create too much of blue sky. We bought for as little as a book value, and we bought as high as, maybe a 5x multiple there. But if you add back the pickups and the synergies, then it brought it down to less than the 2x multiple there. So that's kind of our strategy in that area there. We'll always look at additional automation and restructuring we can do. We're definitely going to add new products and verticals, through adding different products and different things that we can distribute. We have a fantastic platform for distributing products to all these physical retailers, omni retailers, Amazon. It's just a matter of us finding new products and new things to add to complement everything we do. And work within our ecosystems as a small goods warehouse there. I think with that, I'll stop right there. I'm at my 20-minute mark there. So, Craig, I think we should open it up for questions here.
Thank you very much. Click the Q&A button and type your question into the text box. We are only taking your written questions today, so use that Q&A button at the bottom of your text box. We already have some questions submitted, Bruce.
Excellent.
You've made impressive progress reducing your debt levels over the past year. What are your priorities now that you have a stronger balance sheet?
I think Jeff is off
Yep.
mute. So Jeff, I'll let you run with that.
Yeah, I'm here. This is Jeff Walker. I'm CEO. Uh, as we're always looking for acquisitions, I think that is that's the main use of our excess availability. We're looking for good opportunities right now, and the more that we continue to improve our cash position and reduce our debt, allows us to look at more opportunities from the acquisition standpoint. So that's primarily where we're focused on that side with our additional availability, which is pretty strong right now.
Gentlemen, despite the move towards digital media, your vinyl record sales increased 12% in the second quarter. Can you elaborate on why we continue to see growth in this area?
Yeah, vinyl is a super hot collectible, and really you got to look at people really are collecting all sorts of different products these days, and it can be all types of the collectibles that we sell. People collect watches and cars and art and all sorts of different collectibles, and vinyl is one of those collectibles that has nostalgia to it. It's great music. You can actually use your collectible. You can enjoy it. It's a hot collectible, and we don't see it slowing down at all. And you're seeing the artists that in the music industry leaning more into collectibles right now with respect to vinyl. And so it's not only just, hey, let's put out this album. There's new albums, there's reissues. They're doing them in all sorts of different colors and variants. And it's just really creating some great collectible pieces for consumers that like their favorite artists. And we don't see the vinyl business slowing down at all. It's continuing to grow and continuing to get more robust. And I think the music industry is really supporting it with all the artists, and that's a good thing. And we will continue to have vinyl, and we will continue to have digital music. Those two will live side by side together, and it's there's no end in sight for the vinyl records at this time.
Congratulations on all fronts. How do you deal with unsold Paramount titles?
We don't have any unsold Paramount titles yet today. Uh, there and any product, there's a process. Well, first off, you do your best to forecast. So forecasting is the key thing that we spend a lot of time at Alliance focusing on. Is if you have a good forecast and an accurate forecast, uh, when you do that, you're you might be off a month or two of extra stock, a little bit excess, if you forecast well. And so we focus a lot on forecasting. We don't want to be forecasting and have a huge amount of excess. That's a missed forecast when you have something like that. So, all of our purchasing team and our sales team, we focus a lot on our forecasting to really try to minimize having to liquidate any product. And that would be the same case as we go forward with Paramount.
Can you walk us through the strategic rationale for acquiring Handmade by Robots and when you can expect revenues from this new market?
Well, we do currently have revenue. The business was generating revenue when we acquired it. It's been going for several years now. And Bruce mentioned it briefly there in the presentation. Uh, it's it's a uh, it's a very unique style of collectible with a knitted style, and then a combination of that. I love the fact that it's handmade by robots as the brand, with all the robotic conversation today. And to me, this is what a robot would make, and if the robot was making a collectible. So the thing that we really like about it is it also is very connected to movies, TV, gaming, anime, all the different characters and brands and franchises revolving around that. And it's a licensed product, which we also are big supporters of all licensed product. And then, within all those different franchises, there's always new content developed and characters developed. And, we're super excited right now of all the different ones we're working on as they're coming to fruition here. And we've got a lot of characters in the plan right now that we've got designs and we're working on molds and production with that. It's going to be a very fun project. And we will have a standard character, and then there's multiple different special edition variants that we can do. They can be glow in the dark, black light, scented, translucent, oil slick, glitter, all sorts of different variants that we can do on the characters. And it's a pretty exciting area for us going forward. And a little hint, one of the big ones we have coming here in the summer, we've got a line of some Hello Kitty stuff coming out, which is one of the one of the biggest franchises in the world, especially when you're talking about collectible product and fan base and fans behind that. So we're pretty excited about it. There's some huge opportunities in the Handmade by Robot brand.
The new Paramount licensing agreement seems significant. How might this impact your exclusive distribution portfolio and your relationships with retailers like Walmart and Best Buy?
Well, it is our license agreement with Paramount is very significant for Alliance. It's a really great opportunity, not only for us, but for us to really continue to expand the longevity and the collectability of DVDs. DVDs are the same thing. We all refer to our DVDs at home as our DVD collection, and we're going to continue to focus on that, bringing great Paramount product to the market, to consumers. And we really have to spread that out into retail stores, like you mentioned there, as well as e-commerce fulfillment, um, catalogs that we have, all sorts of different ways that we can distribute good media DVD content. And also right now on the DVD side that we're very excited and bullish about. Many of you may know about Steelbooks. They're a much nicer steel box packaging for your favorite movie, and it's more of a collectible version. And we're seeing great success with the steel books that have been released, and we see that as a big growth area for us going forward. And there's definitely some people on the Alliance team, myself included, that think that DVD, from a collection standpoint, could have a resurgence like vinyl records has had recently, and it could be something that people want to have their physical version of their favorite movie in their collection at their house, and they still will watch movies on digital channels and so forth there, but they're going to want to continue to have their favorite movie. No different than people want their favorite album on vinyl. So we're in that conversation, and because of this, we're a good uh, company to continue with that physical product and the sales and growth of it going forward.
Your automation investments at the Kentucky facility seem to be paying off with reduced fulfillment costs. Will we continue to see operational savings over the next 12 to 24 months?
Yeah, I'll take that one too. I think we're always seeing operational savings in our warehouse. Uh, we have a very robust team from our operations side, and Bruce and I are also operational people that are very committed to continuing to be more efficient and reduce costs and so forth there. We did a lot of research when we put in the auto store system. We've got other options to help reduce our costs there in the warehouse, and we're continuing to look at those. I think one of the things over the near future that you got to be thinking about if you're running a warehouse like we are is what kind of other automation can be put in there? Can there be any robotic automation, whether it's some of the simple basic tasks or complicated tasks and things like that? So I think, we're currently looking at all those different options and seeing what fits best for our warehouse. Every warehouse really has different functions and different things that need to be done. And so when you're looking at technology, you have to look at it specifically for your own warehouse, what helps you save costs there, be more efficient, get more capacity through the facility as well. All those different things are critical to look at. And we're always exploring new opportunities there right now and going forward.
What copyrights does AEC own, and what is the distribution term with your content suppliers?
Copyrights, boy, that's a good question. I don't know specifically. We don't own a lot of content as far as music or video or gaming content. We have all of our brands that we've got, but those aren't necessarily copyrights. So we're not focused on a lot of copyrights.
Are you also focused on music publishing ownership?
Not at this time. We're looking at things in there, but we don't have any significant component in that avenue right now.
Your exclusive distribution revenue represents a significant portion of total sales. What's your strategy to continue growing this high-value segment?
Well, exclusive distribution in any product that we sell is a home run for us, and it's very important to be able to build exclusive distribution into the business. When we came up as a one-stop distributor, we're selling music, and there was lots of music distributors. And now, as we've moved forward over the years, we've developed some significant areas in music exclusive distribution. One of those areas is our AMP division, and that's independent music distribution. That is a homegrown business that exceeds 80 million in revenue today. And what that is a significant amount of independent labels rely on Alliance to be their exclusive distributor. We stock all their product in our warehouse and we distribute that to all the retailers. And we do a fantastic job for them on all the websites and e-commerce across the US. And that's a big win for us and a big win for an exclusive label, for a label like our exclusive ones there, is that we have the product in stock. And when Alliance feeds all of the websites, so Amazon, Walmart, Target, Barnes and Noble, and then independent websites and eBay and all these other websites, we feed all the product that's available from that label to all those websites and have it available for sale. So a consumer can buy that labels or artist product, and that will come to us, and we'll pick, pack, and ship it, and put the retailer's name on that package, and that's a big win. It makes sure that wherever consumers buy their music, that product is available, and that's how we're getting such good support from our label partners and exclusive partners, is because of our distribution channels, and specifically our distribution channels on e-commerce, where we really cover all the significant e-commerce retailers in the US.
How do you see the M&A landscape evolving, and what are the next kinds of acquisition targets you are currently evaluating to continue your growth strategy?
Well, I think the Handmade by Robots acquisition was a fantastic one for us. It's a great space for us to be in and a great space for us to grow in there. Going forward, as Bruce mentioned, we are looking at stuff with Diamond right now, and then we're continuing to look at we kind of have a couple strategies. One strategy is any particular area where we currently sell those products and we get a lot of consolidation benefits. And then we also look at areas where it's new to us, but it's very closely related. So when we look at something like why did we buy Handmade by Robots, I give a pretty good description of the benefits of that. And it fits right in our wheelhouse. And I'll give one other example with that is, you know, we have the Paramount product, and SpongeBob has a new movie this Christmas coming out on Paramount, and we can have a pretty significant line of Handmade by Robot SpongeBob characters for fourth quarter this year as well. So we're starting to pair up collectible product with movie product and or music product and so forth there. So anything that relates into that entertainment and especially licensed entertainment products, all those different categories fit into our acquisition strategy going forward, which is pretty big opportunity there.
Your adjusted EBITDA margin improved this quarter. What factors are driving this continued margin expansion going forward?
Well, I think one of the things that really helped us in our margin expansion in this last year was definitely some cost savings as we consolidated warehousing and aspects in that. That happened quite a bit for us in 2025 or 2024 calendar year. Um, as we move forward, we're going to see some margin enhancement from some of the new initiatives that we have going, including the Paramount license deal, as well as the Handmade by Robots um, acquisition. Both of those are licensing um, businesses in a sense. So instead of us being a distributor, we're a licensee in both of those situations. And as a licensee, manufacturer, sales and distribution on it, margin is substantially better as a licensee model than as a distribution or distributor model. So you are seeing us continue to focus and shift as much as we can towards higher margin license products and that side. So that's a significant shift. It is going to help our EBITDA as we get into 25 and 26 and so forth going forward to shift into those higher margin lines of business.
Thank you, gentlemen. We are rapidly closing in on the top of the hour. For more information on Alliance Entertainment, reach us at 1-800-RED-CHIP or email us at aent@redchip.com. Please visit the information page created by RedChip for Alliance Entertainment. It's aentinfo.com. There you can view and download the investor presentation and fact sheet and sign up for news alerts on Alliance Entertainment. RedChip is excited to announce the launch of Red Chat, our advanced AI assistant designed to empower investors with instant, in-depth insights on 4,000 small cap and microcap stocks. Try it now on aentinfo.com or go to red.chat. Watch Small Stocks, Big Money, RedChip's program featuring exciting small cap companies every Saturday night at 7 p.m. Eastern on Bloomberg USA. And finally, join RedChip's next webinar with CanSite Biopharma tomorrow at 4:15 p.m. U.S. Eastern. Register for all RedChip webinars at redchip.com/events, where you can view an archived version of today's webinar. Thank you again to our many participants today, and thank you, Jeff and Bruce.